before you know whether or not that it's a viable opportunity, you got to first determine the value. Because once you determine, you got to know where you're trying to end before you start.
How do you get a seller's and buyer's agreement, the contract? How do you obtain one?
So myriad of ways to do that. So are you speaking exclusively with going off market?
Yes.
Okay. So we don't have necessarily a free one, right? We have one inside of our mentorship program for our students to use. But my guess would be, Ardell, honestly, today you could probably Google like off-market contract, and somebody in their funnel, either as a start of their funnel, will give you a free one or charge you probably $10, $20, $30 for one at the start of their funnel. Okay.
Okay.
If you connect with real estate, well, investor-friendly realtors, it's a good chance that many of them could also have an off-market contract that they use when they're not doing MLS deals, right? Because a lot of agents are now starting to become, at least the investor-friendly ones, are starting to have a wherewithal of how to maneuver deals off market. And in those cases, they shouldn't use like whatever the MLS contract is, because they're not trying to include their broker in that transaction. So even the agent who's investor-friendly should have some inroads to a contract.
Okay.
And maybe maybe we'll do a gift or a giveaway or something. You know what I mean? Maybe it'd be a bonus by the end of this come Friday. Maybe since it's a challenge, we'll challenge some people to do something and possibly give away our proprietary contract. So you never know. It's early.
That'll work. Okay, I got another question.
Yes, sir.
Okay, how do you calculate the ROI?
That's a great question, man. Y'all stealing all my thunder. That's part of today's message. But essentially, the return on investment is the measurement of however much money you have in the deal versus what your return is, right? So if I make $10,000 annually cash flow and I spend $100,000 on the house, I get a 10% return on investment. That's how that's calculated.
Okay. And
it's the money you have committed versus the return that you get out of it.
Okay. And I'm gonna ask one more, and then I'm gonna let somebody else ask a question.
Okay. Don't get me in trouble up here, RD. I don't want no problems on day one with nobody, man. All right.
Okay, I'm gonna keep it short. Okay, what's the rule 72? What's the rule 72?
I couldn't tell. I don't use no rules.
Okay. So that's just a saying, like, you know,
it's cute. You know what I'm saying? Just like the 65% and the 75%. We do good deals. You know what I'm saying? And there's a way you do that without having no kind of jargon attached to it.
Yes, I got a question. I think I got with you guys last week, and I wanted to scale. So I have a rental property here in Florida. Can you guys hear me pretty good? I'm driving.
Yes, sir. I got you, Willie. Over at Umatilla, right?
Umatilla, not Umatilla.
Hey, man, some say Uma, some say Yuma. You know what I'm saying? I'm from up north. I ain't from down here. I'm from around here. You know what I mean?
I love it, Brian. But look what I'm looking at. I want to scale. I want to get me another property. And the property that I have in Umatilla has been paid off for the last 10 years.
Okay.
You know, and I want to either, get money out of that, or should I get money out of my house that I live in as a HELOC?
Okay, so let me first ask you this. What's the current cash flow on the property that you got that's been paid off for 10 years?
Have in there. She's been in there about 6 years, and we've bumped the rent up. It's a 2-1, nice 2-1, okay. And she only pays like $850, something like that, right? Okay. Well, market saying that she should be paying a little bit more, but she done been there 6 years, man. We, she pays on time, and we have no problems with her. So it's
right. So your net cash flow on that deal is like what, $350, something like that after taxes and everything?
The taxes on the property is not that bad. You talking about like the tax.
I'm sorry, Willie, you broke up a little bit.
You talking about the property taxes?
Yeah. Like after all your expenses, property taxes, insurance, like all that. So what's your net cash flow on that? What you think the property worth? If you tell me that, I can tell you the rest.
Oh man, the properties. I've had people offer me like 115, you know, 150. People offer me to purchase it, but I don't want to sell it because I'm,
Yeah. I'm not asking what they offered you though. I'm asking what it's worth. Have you had comps pulled on the property to determine the value?
No, sir. I have not had comps pulled on that though.
Okay. So this week, right, I want you to connect with an agent and get comps pulled, but I'm gonna give you this answer until you get that information for the rest of it, okay?
Fair.
So if me not knowing right now what it's worth, this is what I would tell you. If you getting 850 cash flow, if you know, I don't know how much capital you want to have on hand to deploy, but let's just say it is hypothetically worth 100,000. You do a cash out refinance for 80, depending on what type of rate you can get 30-year fixed. Your debt service all in is going to be, principal, interest, tax, and insurance is probably going to be, 550, 600, right? So what happened is you can pull that capital out and your cash flow is going to basically invert itself. Right now you're getting like 550, you're going to end up on the other side getting probably like 350. In my humble opinion, I would much rather use the investment for the investment, do a cash out refinance on it because it's an investment property. If my debt service keeps it to where I get a decent cash flow, and then deploy that liquid capital into something else rather than leverage my primary residence.
Perfect. I appreciate that.
Okay. But again, I want you to check the comps and determine what the real value is. And then let's have a follow-up conversation to this after you get that.
All right. My question is, because I see a ton of distressed properties that could potentially be used for an investment. How do I know which one would be a good investment?
So kind of the conversation I was just having with Willie, right? So we got this process that we teach called reverse engineering. Okay, that's how we determine our ARV. So what happens is, and just for everybody that don't know, including you, Malik, ARV is the after repair value. Okay, this is synonymous with the projected sales price of what we think the property will be worth after we go in and do whatever renovation to it, et cetera. Okay, we determine that value by the comps. Comps are comparable sold properties that are similar to the property of which you're pursuing. Okay. And it's a myriad of different factors that go into comps. I can't teach all that right now. It's over an hour-long course inside our program. But it's a lot of key components that you need to look at. And we run our comps as if we are an appraiser, because the appraiser is the person that has the final say in what your value is. So what happens is you go out here and it's a lot of agents that don't know how to properly run comps. And no dig to you, Monique, and whatever other agent that may be on here, but it's just a lot of them that don't, right? I'm just telling you. So that's why it's up to us to become proficient at running our own comps so that we can hold everybody else accountable to give us the right information. And I'll say all that to say this. Before you know whether or not that it's a viable opportunity, you got to first determine the value. Because once you determine, you got to know where you're trying to end before you start. So you think with the end in mind. When you determine your ARV, then that would tell you based off of what the ARV is and the rehab is, what your offer price should be. Right? Just because it's distressed don't mean it's good. I heard somebody, and forgive me, somebody put in their homework, I think it was Johnny, that he did a flip and lost almost 20 grand, right? Just because it's distressed don't mean, if the upside ain't there, it ain't no money to be made. So we got this saying in real estate that we make our money when we buy, which is just indicative of the fact that if we don't evaluate and underwrite the deal up front and make sure that there's enough spread, we go through the whole renovation, have a beautiful flip and still lose money. Okay. So that's why I told you guys before, cheap houses are expensive. We got to be careful. Just because something cheap don't mean it's a value. Mm-hmm. So the first thing will be figuring out what the comps are. Secondly, once you determine the ARV, and you can figure out what the value is, then after whatever rehab they need to go into it, you could determine what your offer price needs to be for the deal to be profitable. But it all starts with determining the value though, and working your way backwards. I'm never intrigued by the front end cost of something.